So today we're going to be talking about draws on liquidity to help with bias building. Okay. So this is from top down. Well, I got to mute my Discord. Okay. Top down. This works on every time frame. As I mentioned before, we frame all of our trade ideas from let's do higher time frame, HTF, MTF, all the way down to LTF, which is just execution. This is, well, these are for your bias, right? So you have an HTF bias, and then MTF is kind of like finding your way in price, I always call it, but it's basically just another layer of bias, right? So HTF alone, you're not going to get very many trades, but we can understand where the HTF is heading, what it's pulling to, and then the MTF we use to kind of refine that and find our way inside of these large legs to be able to, profit intraday. So what are draws on liquidity? Okay. So what do you guys know about liquidity so far? Like, what is the importance of it? I'm not looking for anything specific. I just want to know what you guys, like, what your understanding is right now. Anybody, except for Yas.
I was gonna say that.
Anybody at all? Like, how do you guys view liquidity right now? Like, what is?
I mean, there is like multiple ways of liquidity. There is like double bottom, double top, trend line liquidity.
Types of look. So we got equals, right?
Equals, yeah.
You got trend line liquidity.
Trend line. Then there is, I think, pool of liquidity.
So you got, LPs, I call them liquidity pools. I mean, those could be whatever kind, right? Like old highs, old lows, right? Old highs, old lows is a simple one. Old highs and lows, right? Because above and below every low and high is some sort of liquidity. Do you guys understand external versus internal range?
Yeah, I do. I don't know about others.
How about some of the other guys?
I think so.
Okay.
I'm going to say no.
Okay, cool. So we'll touch up on this anyways, but this is not the lesson for today. I just want to kind of get a grasp on where everybody is on liquidity. Okay, but the question I was asking more specifically was like, what role does liquidity play in the market? And also our, let's see how we can word this. Okay, let's call it that. What do you guys think liquidity plays? Like, what role in the market?
So it's like your fuel for your move. Like, you got to have liquidity so all the orders can get filled and push you along.
Okay, fuel for moves, that's definitely one of them. Okay, pockets of money to target, that's true. So we'll just call that targets. Okay. What else? So we got targets. You guys are all coming from FM, I think, right? So you got take. Is everybody here coming from FM?
I don't know. It's probably me and Paul, and who came from Falcon? No. Oh, okay.
Everybody came from FM?
I think so.
Yeah.
Okay. He's poaching.
Yeah. Everybody, everybody came here from FM.
I didn't know that. But
okay. So yeah. So we all understand like LTT, right? And LTT, right? So not that plays a massive role in what we do here, but it's still like something to consider. But also the most important thing, so I was looking for one specific answer, which is liquidity acts as a magnet for price, right? So that's kind of what this is in essence, target and take, but it's liquidity acts as a magnet for price. So when if you subscribe to an algorithm, moving the market, essentially what's going on here is that this algo targets an area of liquidity, and then it will ideally, what it tries to do is create an efficient journey there until it hits it, and then it'll start to select another area of liquidity and then make its journey down to there, right? So this is the idea of draws on liquidity. And hold up. So okay, draw on liquidity, right? Liquidity. So our job here as bias builders is to kind of try and predict basically what the next draw on liquidity is. And so if we understand that when a liquidity target is locked in by this algo, it doesn't really stop on the way there, right? It tries to get there in the most efficient way possible, but at the same time, you want to be able to facilitate orders of, businesses, governments, banks, whatever, right? Because Forex market is the market of the entire world, right? So just like imbalances, residual orders, price has to come back to, fill these orders. People want to facilitate business at prices like this, right? So they can't just go straight up into an area of liquidity and straight down, right? Because Forex is not just a vehicle to trade from, right? It's literally how the whole world works. So today we're going to be talking about draws on liquidity and how that helps us form a bias, and also how to pair that with structure so that we're not just blindly following our ISPs, right? So just like, who was I talking to? Was I talking to you, Bo? Bobin, I think, right? We were talking about, what were we looking at yesterday? EU or the other day? Right here, right?
I don't know what. Oh, yeah.
Yeah. So for example, like, we were looking at this, right? So this was your structural level. We clearly had a sweep, so that gives us an ISP. But my bias, even though we were bullish, it was still bearish, even though like we haven't had any clear signal of it. And that's because we came into higher time frame liquidity, right? So the target was met. Now I understand like how markets move, that more than likely we're going to come down and try and hunt liquidity on the other side, right? Because that target's met. So let's get into some theory with this. What time frame was I writing all that on? Oh, shit. Where did all my drawings go? Okay. So how do markets actually operate, right? So this is what trends really are, okay? So let's say we have uptrends, 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 right? We'd have to ask ourselves, why are we moving like this? This is not like stocks, right? Stocks just go up forever, right? Stocks never stop going up. Forex, on the other hand, is, fundamentals aside, it actually has a job to do, right? Which is facilitate orders. So what reason would it be, disregarding fundamentals, of why price would be pushing up to something, right? We call that draw on liquidity, right? So price is always pushing towards some form of liquidity on every time frame. What we're focusing on, of course, is higher time frame and medium time frame. But let's just talk about higher time frame right now. It's going to trend, it's going to fill imbalance, it's going to take some liquidity on the way up, but ultimately it has a target in mind, and it's not going to change. Target's not going to change until it's met, right? Regardless of economic factors or anything, it needs to be met because there's business that needs to be done at this price, and then it'll start to reverse, right? So let's say we have higher time frame liquidity. We got to draw on liquidity. Only then can we expect some kind of reversal, right? So let's talk about something like this, right? Okay. So oftentimes what happens with traders is they'll look at every little zone, right, on the way up, and then they'll try and short and try and short and try and short and try and short and try and short, and they'll keep getting wrecked, right? Because let's say you have swing structure up, like a swing structure point up here, a swing structure point down here, right? And then they're trying to get that next move down, not understanding that what needs to happen is liquidity needs to be taken, right? And that's where we come into external versus internal, right? But we'll get into that shortly. So when we come into a draw on liquidity, then only then can we expect some kind of reversal, because the market is always going from some sort of, in this case, buy side to sell side, or sell side to buy side, right? So we're fulfilling orders on one side of the market and then coming to fulfill orders on the other side of the market, coming to one side of the market, fulfilling orders on the other side of the market, right? So kind of like this, or you can get a reversal where here we've fulfilled the job on the buy side, And now you start getting indications, which are typically some sort of range, right? And then break down and then hunt some sort of sell side. And typically what happens is it continues down there until the job is done, right? So we don't, most of the time, the market's pretty efficient and you're not going to get confusing price action. If you do, then the best thing to do is just wait till it's clear. Okay. So when we come into a draw on liquidity, even though that potentially on a lower time frame, let's say we have something like this, these are holding. Now that we've come into a draw on liquidity on a higher time frame, we can expect that these medium time frame areas are no longer going to hold because, you know, we've come into a higher time frame area of liquidity. The job is done. There's a very little reason for these to continue hold because there's not much upside that we have to go on, right? Another thing is what is happening during, you know, these draws on liquidity, right? So if I was to ask you again, what is the importance of liquidity? We had fuel for the moves, targets, and take, right? So what do these actually mean, like in reality, in a logical standpoint? Why would the market need to come to areas of liquidity? Let's assume that the market was operated by one massive trader, okay? And which simplifies things a lot, right? So let's just assume that it's one composite man, right? That's some Wyckoff terminology. One composite man that moves the market and he's able to do whatever, wherever, however he wants. Why would he need to come into an area of liquidity?
Is it because it's a zero-sum game where you have to have equal number of orders on each side? If that makes sense.
It is, yeah. No, you're not wrong at all. That's a good answer. More of a technical one, but I'm looking for a simple answer, right? So let's
take out the stop losses, right?
Yeah, but why do they need to go to hunt the stop losses?
So that he can make more money.
Okay, but how? Like what's the actual reason? Like what's going on? Like you're not wrong, but what's actually happening in these areas of liquidity? First off, what is liquidity, right? Liquidity is orders, right? And liquidity helps to facilitate, you know, ease of orders, right? Or exchanging of hands, right? So like, let's look at something like the housing market. The housing market is not really a liquid market, right? It could take you months to sell a house, right? And the more high end the house, the harder it is to sell. If, you know, in Forex, though, it's an extremely liquid market, meaning that I can place $1 million order right now. What is that? 10 lots. I can place 10 lots right now, place $1 million order, and it'll happen in a fraction of a second, right? It's very liquid. Versus a house, I try and sell $1 million house and it's going to take me months. So now the problem is when you scale up to size with billions and billions and billions and billions of dollars, right? Like banks, financial institutions. So what they need to do is they need to push orders or they need to push price into an area of liquidity in order to exit and enter positions. Okay. So, and that's going to displacement. The reason displacement happens is because of lack of liquidity. So they get a big move in the market, right? But when you come into an area of liquidity, they can place a massive amount of sell orders. For example, this is buy side liquidity, which means that when you come into here, there's going to be a shit ton of buyers in the market and a shit ton of sellers. So let's say financial institutions are long here. They push into this area. This area introduces more buyers into the market, and then they're selling into it, right? So let's say this is a breakout. It's some sort of short stop losses, whatever. Doesn't really matter, but they're fulfilling on the opposite side of whatever these, you know, orders are. So in buy side, this would be buy orders. So they're filling in sell orders, and then that pushes price down, right? Here, this is called sell side below. So they push price down. Sellers are introduced into the market. They take buy orders, and then price continues. Right? Someone just joined, I think. Okay. Yeah. So is everyone following that?
Yeah.
Okay, cool. So the reason that it's so important, or sorry, the reason I point that out is because now we understand that liquidity is the main driving force of the market. Supply and demand doesn't matter. Like in reality, supply and demand means absolutely nothing, right? Liquidity is the number one thing that matters, right? Supply and demand is just a result of that. Let's see what else. Like structure doesn't really matter, right? Like I said, draw on liquidity is just happens to be structure because they're going the most efficient route to facilitate all the orders on the way, but the real target is up here. And that's really what's creating structure in the market, right? But, you know, I hope everybody understands that liquidity is the number one thing. Okay, so is everybody caught up to that? Because then we can actually start getting into like trading stuff. Good? Okay,
Yes, for me.
Yeah, I'll take that as
Yeah,
I'll take
we're
that as
good.
everybody's good. Okay, so draw on liquidity in the markets now and in our trading plan and how we build bias. So if we are able to, let's say we have this and we have this, 2 areas of liquidity. Let's say this is a massive, you know, daily range or something, or weekly or monthly range even, right? So let's say we're coming like this, oops. You know, we have these 2 areas of liquidity, right? So we hit this area of liquidity. We start to reverse. Reversals are confirmations, right? So as soon as we reverse, then we can assume that this liquidity has now caused something to happen in the market and change our bias, right? So you get your SMB, right? SMB is your confirmation. Now that we've gotten our SMB, we have to ask ourselves, okay, what is the next likely draw on liquidity, right? So next likely draw on liquidity, right? That's what we always have to ask ourselves. So we've come from sell side. Where would we likely go, guys? If we've just come into sell side and we reverse, where would we likely go? And I don't mean anything on the chart specifically. All I'm asking you is, are we going up or are we going down?
I think we're going up for buy side, right?
Yeah, 100%. So we're going up for some sort of buy side, right? So that buy side can take shape in 2 forms. It can take shape in external or internal. So can someone explain to me what external and internal is? Let's say this is the leg that we're trading in. Okay, from here to here. What is external and what is internal?
Should I say?
Anybody, and it doesn't matter.
Let's say so we're the structure that we are operating. Like we have like here lower time frame structure. So this is all like internal liquidity, and that's why we start going up to take out all this until we get these orders, and then we get done.
Okay, good.
Actually, like here.
Okay, good. And E also answered the question. So internal range liquidity is, so first off, internal range, external range, right? They both have a, you know, a shared word term in there, right? Which is range, right? So range is the leg, right? So this is your price range. Internal means inside, right? So liquidity that resides in here, that could be old highs, old lows, FEGs, which is what we focus on, right? So imbalances is a form of liquidity because there are unfulfilled orders in there. So that's what we mostly focus on, but it could be, you know, equals in the leg, all that stuff, right? External range would be outside of the leg. So sometimes what'll happen, especially we have lack of liquidity in here, is we'll wick up above external leg because that's the next likely draw on liquidity. And then from there, we'll have that reversal and then go to the next draw on liquidity, right? Which would be if we're, let's say we're bearish, then that would be the external part of the leg, right? So typically what happens is what we'll do with order flow, right? If we know about expectational order flow, would be come up into premium of the leg, take internal range liquidity, right? Say there's like some sort of FEG here, reverse, and then come take out external range liquidity, right? So this is just simple higher highs, higher lows, right? So basic stuff, but the main driving force of it is, again, liquidity, right? Okay, so we understand external versus internal range liquidity. We understand now what a draw on liquidity is. And now we need to use this idea here to be able to
frame a bias.
Frame a bias, yes, but also determine how it's possible to trade with that bias, right?
Yep.
So let me just rehash what we just talked about, which was external or order flow, right? So EOF, right? So EOF equals expectational order flow. I don't really like that term, so we'll do IOF order flow. IOF. Institutional order flow, because it's actually makes more sense. You're not, it's not higher highs and higher lows. So institutional order flow is to go from, so let's say downtrend is, all right, let's do external to internal range. External to internal to external, right? So that means that, let's say bearish leg causes boss, then expect to come into internal liquidity in the leg before causing another break of structure. So does that make sense? Right, so let's say here we have the break of structure. Then the expectation is to have some sort of reversal, come into internal range liquidity. Then that's the next part. And then from there, another reversal, and then come and take out external again. Okay. So that's all that institutional order flow is in the most basic sense, right? So how do we use this idea to be able to frame a bias and then also trade from it? Okay. So the first thing that we always have to ask ourselves is, what is the next likely draw on liquidity? This could be in a daily time frame. This could be on a 4-hour time frame, a 1-hour time frame, a 5-minute time frame, a 1-minute time frame. Most of the time, again, we look at HTF and MTF, and then LTF, we kind of a little bit loose with it because it's really just to execute to get better RR on those, medium and higher time frame trade ideas. Okay, so this is something very important. Okay, and it's another little piece of the pie of the entire trading plan is that when the algo has locked in a liquidity target, back to what I said earlier, it efficiently gets there. Okay, so this is why we differentiate between type 1 and type 2 ISPs. Okay, so let's draw this out here. Give me 1 minute. Let's say we got this. Okay. Let's do this. Okay, so this is structure, right? So let's just start mapping out our structure. So if anybody wants to do that for me on the thing, on the with the marker, just map out like our ISPs, our liquidity and whatnot, break a structure. Oh, wait, let's put on some FEGs here. Okay. Okay, so yeah, map out like your ISPs, a sweep and break a structure, anybody.
Me?
Anybody, doesn't matter. I don't care. Yeah, so you could do it too if you want.
Give me a second. That's liquidity. That's a sweep. That's our ISB.
Okay, so we have
This is ISB. Then this is liquidity. This is a
sweep,
sweep.
ISP, liquidity. Okay, liquidity, ISP, beautiful, ISP. Mark out the higher time frame breaker structure and the SMB.
That's your SMB.
Okay, good. So you
SMB.
have breaker structure. Nice. Okay, perfect.
Yeah.
So remove your drawing. Thanks, bro.
Wait, give me a second.
SMB and SMB, right? Okay, so everybody following?
Yep.
Okay, cool. So type 1 and type 2, what is the difference? So we're going to go back a bit. What is the difference between type 1 and type 2? ISPs. Anybody? Except Yas, I know he knows the answer.
I was gonna answer actually.
One takes.
Type
Uh,
one
would it
tends
be?
to hold more, and type 2
Yeah.
doesn't hold as
Okay.
much. It's used for
That's the
internal liquidity. I think I used that term right.
which one is?
Type 2 is used for internal liquidity.
That's absolutely correct. So this is internal, and this is external. This is typically, not always, but typically. That also wasn't the answer that I was looking for. I was looking for a literal definition of it, but you kind of skipped ahead. What is the actual like definition? Like, how do we characterize? Yeah, okay, so E's got it, right? So takes liquidity type 1, and what's the second one? E. So type 1 takes structural liquidity. We'll call that takes structural liquidity. And then type 2 rebalances old imbalances, right? Okay. So if I was to ask you guys, how do I know, like, how can I be confident when a type 2 is going to hold versus when a type 1 is going to hold? Brian, you in here?
Yeah.
Okay. If I was to ask you, how could I possibly know when a type 1 is going to hold over a type 2? Like, what do you think would come to mind first if you just had to guess?
When it sweeps liquidity up to the top of a range.
Okay. So what would that mean? Like, so if we did come up and sweep liquidity at the top of a range, what would you expect? That type 2 holds or doesn't hold?
Type 2 or type 1?
Type 2.
Type 2. I would expect it to hold.
Okay, so let's talk about this. So let's say, you know, we just came up down and then these start to fail. Why in the world would these start to fail? Right? Because they've been holding strong for so long, right? You have 1, 2, then the third one, obviously this one's a type 1, but, and then we suddenly start to reverse and come through it. Why?
Because it's filling those gaps, it's taking it back.
It is, yeah. But how can we build that bias though and like start to expect that they won't hold? And not knowing the answer is fine because I didn't give you it yet, right?
Yeah, but I haven't.
When we get the structure break here, the SMB.
Okay, yeah, well, yeah. So it already kind of, the answer is already kind of in the way that you analyze it anyways. But the main thing is that when we come into a higher time frame draw on liquidity, right? Let's come back to that DOL, right? Or yeah, so DOL. And then next likely draw on liquidity, right? So this is the draw on liquidity, right? So we've come down, we've broken this external range, right? So this was our range. We've broken out. So this is an area of liquidity. You know, you pair that in with like what's going on the higher time frame as well. So let's call this. Yeah, we've come into an area of HTF liquidity. Now the market naturally needs to go towards a next likely draw on liquidity. So that next likely draw on liquidity, the first one to assume is it's going to be type 1s or type 2s, sorry, right? So it's going to be these ranges of type 2s. So if you're coming from fractal, you'd look at this stuff as substructure, right?
Yeah.
These would be substructure highs because they don't sweep. And then you would look at these ones that sweep as your POIs, right?
Yeah.
Right. So what we can assume is after we've hit our draw on liquidity, the algo will look for the next likely draw on liquidity, which will either be external or internal range liquidity. Typically what happens is if we still have a downward target to chase, we'll go towards internal range liquidity, right? Because overall the bias on the higher time frame is still bearish. If it's complete, then we'll come and take out the highs. Another thing to point out is that if there is a lack of liquidity in this leg, for example, something like this, then what would happen is you'd come up and you'd actually pierce above it and take it as liquidity before continuing. Okay. So you've noticed that in the structure work that we did yesterday, right? So understanding this is the very, very, very important part. And again, this is literally the core of the trading plan. So if you guys are paying attention here, you'd understand that structure, the way that we view structure, isn't actually just structure, right? This is taken into account liquidity concepts, it's taken into account order flow, and it's taken into account bias and structure, right? So these ISPs and SMBs, it's simple to map out, but it's actually loaded with information, right? You're able to build, you're able to get, it kind of forces you to get on the right side of the market, right? Now, let's say we've just tapped into here and we've now determined, or we've predicted, you know, you don't know if you're right ever in trading, but let's say we've locked in that this is the next draw on liquidity, right? Would be to take out all of this and then come into our type 1, right? Going back to our last lesson, and I think Christian mentioned this just now, type 1s tend to hold and type 2s tend not to hold. Right? If we understand that we've hit our higher time frame liquidity target, where we have a higher time frame draw on liquidity, right? So let's say that we were only 1 second. Let's do this. Let's make this white. Okay. Right. So let's say we all we see is this, right? And then we have that, let's say we have like some sort of fractal SMB on here, right? So, and then wait, we have this guy, let's put this guy to the front. This guy to the front. Okay, so we have our next likely draw on liquidity, right? Right, so we have liquidity here, and then we understand that we're next likely draw on liquidity is to come up here because we've come down here. What can we understand based on what I said about efficiently moving markets? Going back to the beginning of this lesson, I mentioned that markets move efficiently when they have a liquidity target, and they kind of just try and get there in the most efficient way possible, right? So what can we take out of that information? Efficient delivery would be to come back and fill in balance, continue on, and fill in balance, continue on, right? So what we can expect when we've now chosen a new liquidity target is that type 2s will begin to hold all the way there, right? So what on the way that, so just like when we came here, we've had a target of liquidity, type 2s hold consistently. They don't fail. Here, on the way up, what we can expect is that type 2s will hold. Let's say there's imbalance in here, right? Imbalance in here. These type 2s will hold until the target is met. So we're able to, the whole plan of our trading system is to determine the draw on liquidity, because that gives us a bulletproof bias of how to trade it by following these type 2s all the way up there. Okay. And then when we get there, we have to ask ourselves, okay, now that we've gotten there, there's a possibility that will reverse because, you know, the objective is met, right? So because the objective is met, we understand that these type 2s are done their job and they're unimportant. There's no reason to continue doing that. So then we can expect that they break, right? Is everyone following?
Yeah.
Any questions? Now's a good time to ask questions because we just went through a shit load of information.
So is it always that type 2 holds when it's pullback, or like that's just something like example that you said?
Generally, it holds. Like generally, it holds consistently, and we'll look at that on the chart, right? So generally, when there's a higher time frame area or draw on liquidity, type 2s are going to hold until we get there. Generally, when there's a draw on liquidity, type 2s are going to hold until we get there. On every time frame, right? I don't look too much on the lower time frames, so the lower time frames tend to just do whatever the hell they want, right?
Yeah,
So,
that's how your what's his name, PK?
Yeah,
that's how he entered the trade last night, right?
yeah, right. So he's following that, and me too, right? I took a trade on GU. We can go look at that right now. Let's see here, and I could have held that trade with really no problem, right? So let's look at this. So let's look at this in reality. So HTF liquidation, right? So we've just had an HTF liquidation. What do we expect?
to go for another liquidity sell
Yeah.
side.
So we just took buy side. We're expecting that we'll come take sell side, right? So this was our most recent ISP. Let's see here. We come into here. So you have this one, right? And then that's it, right? So there's your break, right?
Yeah.
And then where does the SMB happen?
But it's right here, right?
Right. So you have this one, SMB, and then you have a sure one, right? You have this one is absolutely 100% sure.
Yeah.
Like you've come and taken out a type 1, right? So this one is really your last line of defense, right? So when there's a type 1, for example, a type 2, sorry, it's possible that we use that as liquidity and continue up. But when we come take out this type 2, we know for sure that, this is a confirmed SMB now, and we're bearish, right?
Okay.
So let's map out liquidity here, okay? Not that you're wrong, you're right here, but I'm gonna, for ease of explanation.
Yeah, I understand. I understand.
Okay, so map out liquidity, like sell side liquidity. So let's just assume I'm gonna put this up here, blah, 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 like so. Map out sell side liquidity on the higher time frame. I'll even
Here on the
I'll even do this.
left
Like,
side.
where is sell side liquidity here? Just map it out.
Okay, so like we started a move from up here. So let's say this, and this.
Okay, yeah, that's buy side though, right? We're looking for sell side.
Oh, the other side.
Yeah.
Okay, let's go from the bottom.
Okay, perfect, right? So you have your obvious sell side target right here.
Yeah, and also like, I mean, if we're
Oops.
gonna target,
Yeah, and you have there. Okay, so you have sell side, you have also, you have sell side down here, right? So usually what I'm looking at is structural stuff as my next draw on liquidity. If it's, if we're expecting to go down, quick little tip. If we're expecting to go down, then we're looking at sell side liquidity on external. And because we're going down, we're looking for buy side on internal, right? Okay, so now we understand that our sell side target is this, right? So this is that. What do you call it, guys? Next likely
draw on liquidity.
Yeah.
Next likely draw on liquidity. Yeah.
next likely draw on liquidity, right? So NLDOL, or basically DOL, draw on liquidity. Okay, so next likely draw on liquidity is here. Okay, so now what we do, so this is on the 4 hour or the 1 hour now, right? So on the 1 hour, I have a clear next likely draw on liquidity. Everything is kind of satisfied on this end. And now basically what I do when I have to drop into the lower time frame is try and understand how it's going to deliver to that level, right? Okay, so what do we understand about when a draw on liquidity target is locked in? Mentioned it before.
Trying to get there as efficiently as possible.
Beautiful. Okay, so what does that mean is going to hold? Type 1s, type 2s. E says type 2s. That's 100% correct, right? So what can we do as traders, right? If we understand that type 2s are generally going to hold, what is our job then? Is to figure out and trade
From
Type 2.
type 2.
exactly.
Yeah,
So
from fair value gap.
Exactly. Simple, right? Our job now is only to determine where type 2s can form and then try and trade them as they happen. Okay. So we understand that up until we reach this level, type 2 should continue to hold, right? So if you're coming from fractal, you'd call that substructure, right? So your substructure should hold. Okay. So in this case, we call those type 2s. Substructure this is substructure where, how we learn, right? So we can map out our FEGs. Okay. Does everybody here know what an FEG is? Like me and Pat are going to put up PDFs explaining all of this, but does everyone have a rough idea? It's a 3 candle formation with imbalance in the middle. Good. I think we can all understand that, right? So you have candle 1, you have candle 2, which is this big one with the imbalance, and then you have the third candle, right? So this is your FEG, and then even this technically is an FEG because you have 1, and you have 2, and then you have 3, and then that gap in the middle, right?
I have a question about FEGs.
Sure.
are they forming anywhere, or there is any specific rules like it has to be from institutional candle or something like that? Is there any
So
rule about them, or
they're technically anywhere, but generally what you want to see and how you trade FVGs effectively is when they develop after a draw on liquidity. Okay. So
Okay.
because we've had a big sweep here, we've taken liquidity and then we created an FVG that broke structure. This is a valid FVG, right?
okay, yeah,
So again, 3 steps. First one, draw on liquidity. And this is literally the whole entry model, right? So like sneak peek, this is literally, it's as simple as this. Draw on liquidity, FVG, and then you want to see that FVG break structure because that just gives it, you know, that has, now you have order flow on your side and you can expect that it holds. Okay. So looking at this leg now, we've broken structure. You have this whole thing here, right? This is a giant news wick. Rule of thumb, when I see a giant news wick, I just measure from bodies. Okay. Where is the next area that a type 2 can form?
it's the only place here that you marked, right?
Yeah. Okay. So we can assume that a type 2 can hold in here, right? So when price comes in here, would it be safe to assume that, let's make this blue. Would it be safe to assume that we can look for entries now in here?
Absolutely.
100%. So what are our 2 targets? Now, if we start coming back here, okay, beautiful in there. What are the 2 possible take profit points? Understanding what we know about order flow and draws on liquidity.
Yeah,
Perfect, right? So we understand that the higher time frame is telling us to go here, and then the 15-minute obviously is telling us to go here, right? So we can assume that this is going to hold and it's going to take us to a minimum this point, but because we've built that higher time frame bias, we could confidently say that we're going to come to this draw on liquidity efficiently, right? So let's see how, just skip through and see how price develops. So type 1 holds, right? Well, it's not really a type 2, sorry, type 2 until it breaks, right? So it's unconfirmed for now. Okay. Let's see, did we close body? No body yet. Still no body. Okay, choppy chop. Okay, so then we move that to there because the wick. You can call this one your breaker structure, right? Okay, right? So breaker structure. And then from here, right, we still haven't met the target. So what can we assume still? Because we haven't met this target. What do we know about efficient delivery? What can we assume?
This other
Yeah,
gap
it
needs to
can-
get filled here.
Right. So it should. So would it be would it be fair to say that this should be protected
yeah,
Yeah.
because we still didn't break down.
because we still didn't break, right? So we should understand that the highest probability setups are coming from these development of type 2s, not necessarily type 1s. Okay. So this should hold, right? This is likely to hold. Now you have to factor in a couple other things, right? Like there's very little liquidity in this leg. Because there's very little liquidity in this leg, we may actually pierce above this. But for the sake of it, this should hold. And it does, right? So there's your second type 2. And now that we've come and pierced this, what is likely to happen, or what can potentially happen? What do we have to be cautious about?
About all this ISPs now holding, maybe it can happen like pullback over here before breaking another structure, right?
Absolutely, right? So that's what you call efficient trend, right? So let's see this.
Yeah.
You have this whole entire leg. Again, when it's a Newswick, this is my little thing, but I don't really like to look at them. What's likely to happen is that we're going to come take some form of liquidity inside of this leg, right? Some internal range liquidity before continuing down. You know, that's not to say that we don't just continue up, but of course, when we're trading, we understand there's 1 trade opportunity, 2 trade opportunities, 3 trade opportunities already, right? Not that they'll all get you'll get an entry model in all of them, but you have 3 potential tradable zones in how long? In only 21 hours. So in a single day, you have 3 potential tradable zones, right?
Yeah.
Now, And there you go, right? So as soon as we've come into that draw on liquidity, this one's already failed, right? And what do you get here?
SMB, but I think this ISP failed because it didn't.
It
buy
didn't
close
close.
as
Yeah,
well.
so you're right. On a fractal level, this is an SMB. Okay, so if I was to go
Okay,
down
okay.
onto like, I don't know, the 15-minute or whatever, right?
Yeah. So.
Even the 15-minute doesn't close. So we don't assume it's an
But-
SMB, but it's safe to assume that it would probably be pretty stupid to trade from here, even if we did close, because we've come into that draw on liquidity, right? So we can
That's
start to
true.
expect that these levels fail. So we have a failure here. We might get a failure here. We might get a failure here. But now what do we see? We see a little bit of liquidity buildup. So it depends on how we deliver in, right? So if we get some delivery, some good delivery, then this might be an area that will hold. But generally, what do we know? Again, going back to, where's all my writing? Going back here. Going back to what we know about type 1s and type 2s. What do we generally know about type 1s?
That it grabs liquidity and keeps going in the direction.
And what can we expect when price comes into a type 1 area?
The grab of liquidity and
No, let's say this is already developed. So the type 1's there, we've pushed down. The expectation is that when we come back into a type 1, we can expect some sort of reaction, right? So just like in FM, the POI selection chart where, if it's a sweeping POI, you can expect a reaction, right? So it's the same thing, right? A type 1 structure point, you can expect a reaction from, right? So we have to pair that up with other things like, is there liquidity to come into that area, or is there not? Then we can use it as liquidity, right? But we have to take into context order flow, right? So that's where long-term points come in too, right? So for example, let's say that there's a little bit of, imbalance in here, right? That gives us a type 2, right? So we have lower one on the right and the left. So this becomes a swing point, right? So if our swing bias is to put in new lows, we build confluences like we have internal range liquidity to take into the type 1, then we can start to look for confirmations in here on the lower time frame, or be patient, wait for the SMB. And then again, what do we know about? So an SMB just means that the pullback phase is confirmed to be complete, but let's talk about this now. So we have our draw on liquidity. We have our draw on liquidity. Where is the next likely draw on liquidity, especially with the confirmation of the SMB?
so
Anybody?
it should be like down here.
Beautiful. So your next likely to draw on liquidity is down here, right? So next likely draw on liquidity. What do we know about order flow, Brian, when we have a liquidity target? What do we understand about order flow?
Well, it's got to come back and fill these orders.
Yeah, so wait, let's just assume that this didn't break. Okay. So
Okay.
let's just assume that all we see is this. Okay, we just had the SMB. We have this draw on liquidity that pushed us back up. Then we had this draw on liquidity, and we're calling this our next likely draw on liquidity.
Okay.
What do we know about price when it has the next likely draw on liquidity and how it's going to get there?
We assume it's going to come down and fill it.
Yeah, it is going to come down, but how is it going to develop? Like how is the journey there gonna happen? Is it
Like
going to
you're
be?
talking about order flow, like how it has to balance itself, or
Yeah, exactly,
I'm
right.
not sure.
No,
Yeah.
you're right. You just answered it. So we understand simply that, type 2s are going to hold, right? Which is the filling of imbalance, right?
Right.
So we're going to go there in the most efficient way possible and just fill these type 2s, right? So again, as soon as we had that SMB, we have that next likely draw on liquidity, the SMB kind of confirms it. Then we just look for the imbalances and the FEGs to tap into, create the type 2s, and we just keep trading that. And we keep trading that and keep trading that until it happens. And that's
Okay.
literally the entire trading plan, like completely. Then we throw in a simple ass entry model, and that's it. All you're doing excuse me, all you're doing is two things, okay? The first thing is about liquidity. Liquidity is cause for reversals, okay? So without liquidity, markets tend not to reverse, okay? So in here, we haven't hit any liquidity, we don't reverse. When we do hit an area of liquidity, we finally reverse, right? Like for example, here, we hit an area of liquidity, we reverse. We come up here, we take liquidity, we reverse. We come down here, we take liquidity, we can potentially reverse. But if there's no liquidity in the equation, then the probabilities are on the side of just continuing and not reversing, okay? So going back to this, right? SMC guys trying to trade from every little zone, it doesn't work, you get smoked because there's no liquidity. For reversals to happen, you need liquidity in the market, right? So, I mean, this is a horrible example, but I'm sure you guys are intelligent enough to understand what I'm saying, but there's no liquidity in this leg, get smoked, right? So let's say that this didn't exist. There's no liquidity in this leg, get smoked. There's no liquidity in this leg, get smoked, right? But if there was some sort of a buildup of liquidity, if there was some sort of a buildup of liquidity, right? Come on. Liquidity, right? If there's a buildup of liquidity, then we can start to look at, okay, there's liquidity and liquidity is needed to reverse. So maybe this is possible, you know, area that we can reverse from only because there's liquidity, right? So what you guys got to know is that reversals don't ever happen unless there's liquidity. And as a trader, you need to be on the side of, you know, the most probable case, which is generally that. So any questions, guys? Is everybody following, or is anybody overloaded with info right now? Yeah, what's up, E? Okay. Yeah, so let's that needs to be an ISP. So let's just assume that that was, you know, filling some sort of imbalance. Yeah. If it's not an ISP and it's just substructure, then it's not an SMB. Okay, no problem. Anybody else?
I have a question. Like, what if there is like formed in the three types of candles? Like, last two candles are like FVGs. So how do we recognize? Should we go on a higher time frame or?
So you mean if there's like two FVGs back to back?
Yeah.
Okay, so you can go on a higher time frame and then you would see that it's all one FVG. Then there's another thing as well, but we haven't gotten into that, which you'll learn right after the weekend, and it's kind of part of the PDFs, which is basically stacking confluences with your FVGs, which kind of helps you to pick them. So this is actually this brings me to my next part of this whole live, which is, should I separate this one into another live? I don't know. It depends how you guys feeling. Is this too much information for one day, or do you want to throw in some more right now? Because I can also just turn it into a separate video if you guys like. But there's just one last thing. It's called first and last line of defense. Do you guys want time to process this, or do you want to continue?
Yeah,
I
throw it
don't
in
mind,
there,
but-
but maybe cut it up.
Cut it up into
Okay.
different things?
Well, let's see it now, but maybe cut them
Okay,
up
so
just so we
yeah,
can.
sure. So I'll do both. I'll show you guys now, and then I'll make a video on it as well. Okay, cool. So this is a little exercise that I want you guys to do. Okay, so you can go on to like any chart you want, weekly chart, daily chart, whatever. I like to stick with daily chart. Okay, let's find a very clear one. So This is pretty clear. Okay, so this is pretty clear. So we call this first and last line of defense, or first line of defense. So we're just going to follow order flow. Okay, so let's just pick 2 random points in price. See, this is very efficient price, right? So this is there's not much like big moves in one direction, right? So, you know, everything that's happening in here is well filled out. Okay, so this generally makes it really easy to do this exercise. But let's just follow price here. So point out the most obvious sweeping points, and sweeping points, so like the external parts of the structure, and let's just see what happens. So you have, what do you call this? A draw on liquidity.
Liquidity.
Right. So you have a draw on liquidity here. So this is where we'll start from. And now figure out where is the next likely draw on liquidity. And let's just look at, well, yeah, okay. So you have one here and one here. Beautiful. Okay, so one here and one here, right? So you have 2 areas of liquidity that price is likely to go to. So let's follow price as it goes. So let's do, we're going to call this one a first line of defense. So that's what we're always asking ourselves. So in this case, we're going lower. We're going to ask ourselves this. If we're going to go lower, where are we going lower from? Okay. So we've pushed down.
Build imbalance.
We've pushed down, continues push down. We break structure here. And now we start to pull up. Now we have to ask ourselves, if we're going lower, where are we likely going lower from? Right. And I don't mean in this leg. I mean, just in general, right? Let's look at supply and demand even. If we're going lower, where are we going lower from? Oops. Okay. Right. So we have this area here. Okay. Then we push down, we break structure, we start to pull up. If we're going lower, where are we going lower from? FEG, 100% FEG, not wrong. But at the bare minimum is this one, FEG, 100%, right? So, and what do you see here is the first line, right? The first line is the FEG, right? And here, this FEG is respected. About FEGs, even if it breaks above, it doesn't matter as long as bodies close below it. If bodies close outside of it, then it's invalid. Okay, we've broken here. Oops, so broken here. Then we ask ourselves, if we're going higher, where are we going? Or if we're going lower, where are we likely going lower from? Here. In this case, we've pushed out and broken above, right? So let's look at this. So this is going back to the draw on liquidity. So this was the higher time frame draw on liquidity, right? So what we expect until we hit this target is that we're going to start moving pretty efficiently and not break structural levels, right? So these would be your type 1s, right? Or type 2, sorry, type 2, reacting to imbalance. This one's filling imbalance. Yes, it takes a little bit of internal structure, but it's not taking any sort of structural liquidity, right? In this case, after we've had that draw on liquidity, we come and take this out, right? And then we reverse and break down. So look in here, break down, continues down. Here we have a little bit of a pullback, and then we have to ask ourselves, if we are going lower, where are we going lower from? This is our draw on liquidity. Okay, so let's assume that we are not there yet. Let's actually do this. Let's play it like this, so it makes more sense. You guys don't think I'm cheating. So if we're going lower, where are we going lower from, right? So we're going to look at this level. Most obvious supply and demand one. This is the first one that happens, right? So this would be the second one. This is the first area that we can reverse from. Again, like this one. There's no area we can reverse from. This is the first one. This one, no area we can reverse from. This is the first one. This one, this is the first one, right? Okay, we've hit the draw on liquidity. Now from here, we can expect that we'll run some form of external liquidity. Right. So what we would ask ourselves from here, let's go back a bit, is if we were to continue down, right? If we were to continue further down, where would we reverse from? Or where would we go down from? Which would be the first one, right? So this is the first one going down, doesn't really hold, breaks out. When it breaks out, then we shift our bias. So we call this an SMB, right? Hopefully this all comes together in a second. And now from here, we ask ourselves, if we're going higher, right? Because now we're going higher to some sort of a draw on liquidity, right? We have, oops, we have this one. And then we have like structural liquidity up in here. If we're going higher, where are we going higher from, right? So then we look at that next area of supply demand, right? So this one, we're going higher from, we do tap into it. I don't see anything specifically that, you know, we can catch on to, so we just skip in price. Okay, we push down. Now we ask ourselves, there's your SMB again. We ask ourselves, if we're going lower, where are we going lower from? Anybody? What's the first thing that stands out if we want to go lower and then take out this draw on liquidity? Beautiful. Okay, so you guys are getting it already.
Yep.
Hopefully this is coming together, right? So this one, so if we are to continue bearish efficiently, we shouldn't have any reason to come up here, right? We really should not have any reason to come up here. If we push down above this, then it's most likely that this is the structure in control and we're just going to take out this. But if we want to follow bearish order flow here to our drawn liquidity, if this is in fact the liquidity target, then these type 2s that happen, these first lines of defense should hold, right? So that could be a type 2, for example. It could be even supply and demand, right? Okay, so we don't hold. So this should break, right? Now, that's not always the case, but generally should break, and it broke, right? So now we have to ask ourselves, we had to break a structure again. So if we're going higher, so this becomes a target, right? If we're going higher, where are we going higher from? Okay, so there's this one, but there's also this, okay, which is called a breaker block, which we're going to get over that on the weekend. But you can see this whole range, right? This whole supply and demand range, right? The sell to buy. We shouldn't really come below here. Let's see if there's an FEG that happens here. Okay, so from here, this is stacking confluences. If we're to come up here efficiently as possible, we shouldn't come below this FEG. This is the first line of defense. Okay, now we push down. We're likely going to come deeper. We didn't take the draw on liquidity, but we're reacting to that type 1. This is a type 1 because it sweeps. And that's what we know about type 1s is they usually get a reaction. We have plenty of internal range liquidity. Let's see what happens. Okay. If we're going lower, where are we going lower from? Of course, we didn't have that break, right? But if we're going lower, where are we going lower from? Right.
It's maybe up here or no?
So yeah,
Or
this
we're
one, but
looking
the,
at that line?
the first line of defense, right, is here.
Okay.
Okay, it doesn't take out the low, fails to take out the low, so we're probably going to come a little higher. But nope, see, there you go. First line of defense hold, right? So this is how we follow order flow. We don't have to always look at extremes, right?
Yeah.
Because that takes forever to get to, right? What we're doing here is we're identifying the drawn liquidity and the most efficient path for it to get there. That's our job. So doing this exercise of first line of defense, where are we going and how are we likely to get there? That's what you're always asking yourselves. So we're going up. We say, if we're going higher, because we have a target here, if we're going higher, where are we likely going higher from? So it was this one, right? And then in here, we failed to take out this high. We push lower again. And we looked at this as our next likely drawn liquidity. And we ask ourselves, if we're going lower, because the drawn liquidity is below, where are we likely going lower from? So what is the first line of defense? And that's this one. And then there you go. Right? So are you guys clear on what this exercise is?
So are you looking for like supply and demand blocks opposed to FVGs here now, or
So I'm looking at both, right? I'm looking at both. So supply and demand really, so the way FEGs work, right? Let's see here. Let me just take a screenshot. Hold on. Let's do this. Let me take a screenshot of 3 candles here. So, right. So this is the way an FEG works, right? So we have a clear fair value gap in here, right? So the rule of thumb is that yes, if a body closes above, it's invalid, but you know, we can have a wick up all the way up into here and then close below and it's still valid. But generally the rule of thumb is that the price shouldn't come above candle 3. Okay. Or like the swing high basically, right? So this generally is how, you know, other SMC communities look at supply and demand, right? That last stop candle before the down move. But in reality, it's just how FEGs operate. So even though we're looking at, like, for example, this level here, this demand or supply or demand level, supply level here, really like what we're focusing on is like, is it going to come above this high or is it going to come above this high? Otherwise this FEG is invalidated, right? And just like this one, right? Here's the FEG. Just because we've pierced above it doesn't really matter. I mean, as long as we don't come above that candle 1. Okay. So I'm going to let you guys be a little, you know, loose with it because I want you guys to experiment and kind of figure out how price is doing this, but go map out the FEGs, go map out the whole supply and demand as well, right? It's like, there's no FEG in here, but there's just this one, and this one gets ran through, right? But yeah, first line of defense in this case, there's really no liquidity, so it should be this whole supply and demand, right? And this is just how we follow order flow. Okay, so we've tapped in below here. If we want to go lower, where should we go lower from? Yeah. Okay. So we have FEG. FEG is right here. So we shouldn't come, so we have to look at the highest point above the FEG. So we shouldn't come above here, right? But we should actually have reactions from like this candle here that cause the FEG, right? Like this realistically should be where we get a reaction from. Let's go ahead. Okay, we've broken structure now. So if we're to go lower, where are we going lower from? Ignoring that, we understand that we've just come into liquidity and it's likely to pull up. If we're going lower, where are we likely to go lower from? Beautiful. So we shouldn't really come much above this range here, right? Tap into the FEG, overlap the FEG with S&D. Okay, we've broken above, right? That's expected. Okay, now we have to ask ourselves, well, if we're going to go higher, where are we likely to go higher from?
So this should be.
Actually, Brian, you asked the question, right?
yeah,
Okay, so a better way to word it is, what is the first thing that price can react to? That could be an FEG, that could be a supply and demand, or it could be both, okay? So in this case, yeah, so that's a better way to answer the question. If we're to pull back, what is the first form of support, so to speak, that we're going to hit?
support like this whole range here or the FEG?
You got this one, you got the FEG, but what about the whole down move? Right, like this. What about this whole sell to buy, right?
Yeah, I guess.
So this would be the first one that we tap into. So if we're going to go higher, really what should happen is we shouldn't come that much lower than here. If we're going to push lower, then we might actually start to break down further. Let's see here. Okay. Reacting to this FEG is still holding because we haven't broken above. Haven't broken above. Haven't broken above. Okay, so we tap just into it. Okay, there we go. And okay, now we're all the way at the bottom. So we might actually be going lower, right? So this demand level here is holding. Might be going lower. Okay, so we've actually pushed down all the way here. So this, if we're going to dance around in here, technically what this means is we're going to have some sort of like big reversal in play. But okay, push down. All right. So if we're going lower, where are we going lower from? And I should have asked that here as well. Right. So let's actually take that a step back. Okay. So here I asked if we're going higher, where are we likely going higher from? Right. And we said that it would be this level here. That level didn't produce the reaction we wanted. We started to break down. Then we have to ask ourselves, if we're going lower to this target, where are we likely to go lower from? From here.
This whole candle.
Yeah, you got the whole candle, you got that FEG, right? And then you
Right.
have this one here as well.
But there is also a
True.
FG down here.
Yeah,
Right.
so we also have this one here. Do we actually react to that? We actually do react to that. Let's see what happens. Right, but we have plenty of FEGs and we want to be stacking confluences as well. So our first line really is here. Technically, this is not incorrect, and there's probably a trade in there on a lower time frame anyways. So you don't really have to get it. You don't have to be right on your bias all the time to actually get profitable trades. But yeah, so we react to this one and we push down. And this is because there's stacked confluences on a lower time frame as well, right? And also, we kind of want to be considering like premium discount as well. Okay, so if we're going lower, where are we likely going lower from? Okay, so we have this FEG you pointed out.
Yeah.
Okay, so we have this FEG, and now we want to see, okay, what else is there? Okay, there's this as well, right? There's this whole demand range, this whole buy to sell candle, right? They stack up. This really, if we're going efficiently down, we should catch on to this and then continue. Okay, it holds, still holding, still holding, still holding. Okay, news pushes us down, and you can see that it still holds, pushes us down, and then, now we're starting to break. Okay, still holding technically, right? And you can see how, okay, so very choppy. I mean, it's news, right? But you can still see how that first line of defense is holding if we want to keep efficiently pushing lower. Okay, from here, if we're to continue lower, where are we likely going lower from? Beautiful. So you have FEG. You have full buy to sell range stacked on top. We should come just into the top of this and come down. We're only invalidated when we come above that. Okay, look at the FEG, the bodies, right? Look at the bodies hold. Okay, now we've broken through that FEG. Now we ask ourselves, if we're going higher, where are we likely going higher from? What's the first line of defense to go higher?
So we take the whole candle that caused the push up, right?
Yeah, so I always map out the FEG, right? And then I want to see what is the FEG stacked with, right? So I'll say, okay, we have this whole level. So we're really invalidated below here, but what we want to see for efficient price action is really just to come into that first line of defense. So we shouldn't really come too far below here if we want to come take out, the next likely drawn liquidity. So let's just call it this, right? Because it's the most obvious one right now. See, taps in and goes, right?
Mm-hmm.
And this is literally on repeat. You could do this all day long. Okay, so this is the exercise that I'm going to give you guys to do, and guys can go as long as you want. What else would be pretty good is if you guys actually recorded it. Now, I'm not going to go watch 3 hours of videos from each of you, but if you can record it, first off, for your own sake, second off, like I'll watch 10 minutes of it and make sure you guys are doing it right. But yeah, go to a random price action on the daily chart of any pair whatsoever and just do this exercise. All right.
Yeah.
So you want it with liquidity, supply demand, FEGs, and then
Yeah.
obviously structure. All right.
Yeah.
Cool.
Do everything that you guys have learned. I'm assuming that you guys understand what supply and demand is, right? Like I don't have to teach you. It's pretty much the same across the board. Right?
Yeah.
So what I want you guys
Yeah.
to focus on is draw on liquidity, pick a draw on liquidity, right? So in this case, when we started to reverse up, this first line of defense failed. We mapped out the next likely draw on liquidity. And then ask yourselves, okay, if we're going to get there, what is the most efficient path there? Right? So that'd be your first line of defense, right? Which in this case was this FEG with the supply and demand. It's the first one. And you can see how efficiently we get there. So that's what I want you guys to do, because this is going to build you guys the muscle of not feeling like you always have to wait for this to come, right? That never, ever comes, right? Like this may come eventually, you know, how long has it been now since this break? It's been, it's already been, you know, it's already been 78 days. So, you know what I mean? Before we get to the extreme. And we don't even know if that's going to come. Yeah. Right. Oh, there you go. Now you hit the extreme and it ends up, you know, running through it. So the idea is to build the muscle to actually follow order flow as it happens efficiently, because that's how markets develop. And then you can do this fractally, which we'll get to on like the 4 hour and the 1 hour, and build really, really good trade ideas to be able to take trades. Doesn't matter where the market is, just how it develops. Any questions from anybody? Concerns, critiques? Are you guys happy?
Yes, this is like as simple as it gets,
Yeah.
literally.
Awesome. So you guys pleased with where this is going so far overall? Like to hear some feedback.
Yes. You make it really
Yeah,
simple.
it's good, man.
Awesome. All right, guys. Well, I'm gonna call it a day. I'll see you guys in the chat.
Sir, have a good
And
day.
Awesome.
then
Thank you.
Have a
yeah,
nice
no
day, man.
problem. Thank you guys for stopping by. And also, yeah, do this. I'm gonna upload this as soon as possible so you guys can rewatch and this exercise, okay? As much as you can.
Yeah.
Do it every day. Fuck it. Like seriously, do it 20 minutes a day, 10 minutes a day. That's the type of stuff, like hammering this down for 6 hours a day. Yes, I know you're gonna do that. Hammering it down for 6 hours a day is not actually gonna help you that much. But if you can do it for 20 minutes a day, consistently every day for 3 months, that's what really helps you. All right. On that note, I'll let you
Alright.
guys go.
Yeah, thank you.
Thanks, man.
Mm,
Take
See
it
you.
easy, guys. Thanks for stopping by.
Bye.
Bye.
Bye.